Hi, welcome back. In this session, I'd like to talk about an IPO that's poised to go public today or tomorrow. In fact, it's pretty close to the offering day, and it's the IPO of Instacart. Now, this is, of course, a company that became a COVID favorite during 2020. It zoomed like Zoom and Peloton, and it's had a coming down, a reality check since. In fact, since 2020, at the peak of its glory, we've had rumors going around that Instacart is planning to go public, though the number at which it plans to go public has slipped over time, from 35 billion, 40 billion down to the 9 to 10 billion that is rumored to be the pricing for its equity. So coming in the week after ARM, the AI chip designer, went public, this is a test as much for the company as it is for the market, because the reception that Instacart gets is, I think, going to give us an indication as to where risk capital is in this market. So as we look at the pricing of this company and how it slid over time, it is also a reflection of how much things have changed since 2020. So to value the company, let's start with a basic understanding of how Instacart makes money. Now, I know many of you used Instacart, and I recognize that you already recognize it, but it's good to see a business model before you start to value it. As most of you know, Instacart operates as an intermediary between the grocery store and you. It allows you to order from a grocery store the items you want on your list and have them either delivered to you or picked up at the store. So what Instacart offers is an app that connects you to multiple grocery stores. Now, if you think about why a customer might like it, during 2020, the answer was easy. It was because you had no choice. You were homebound and you had to have groceries delivered to you. And once COVID passed, though, and you could go back to the grocery store, the main benefits you get are convenience, because you can order from home, time savings, and perhaps if you like to shop at multiple grocery stores, a way of preserving that choice. Now you're saying, why would grocery stores like to build on? And you can see here there's a struggle. For grocery stores, there's a trade-off. By partnering with Instacart, they open up demand from people who might not otherwise have shopped at the store. People who are, as I said, homebound or could not come to the store. But it comes at the cost it comes with is a slice of the revenues you get from each order ends up with Instacart. In addition, the information about the customer, what they like to order, the data you're collecting ends up with Instacart rather than the grocery store. That friction is going to play out as you look at what's happened to Instacart since 2020. That tells you why customers like Instacart, why grocery stores buy into it. Let's talk about why Instacart does what it is. How does it make money? The core value proposition, the core revenue proposition for Instacart comes from transaction fees. When you order from a grocery store, a percentage of that order goes to Instacart, between 5 and 10%. It varies based on the store you order from. It varies based on the size of your order. And it also varies depending on whether you want to pick up your order or have it delivered at home. So that's a core revenue. In addition, Instacart introduced a subscription service called Instacart Express, where if you subscribe for either on a monthly basis or an annual basis, you could first stop paying a portion of the delivery fee, the $3.75 delivery fee. And you also got a few special deals that non-subscribers did not get. There's a third source of revenues, which is Instacart on its platform allowed stores to highlight products, as well as product makers to highlight products. So those ads presumably drew customers in to buying that product, and in return, Instacart got ad revenues. So intermediary and service fees, subscription revenues, ad revenues. Now the intermediary and service fees and subscription revenues you can bunch together. They come from transactions. The advertising revenues are a separate source of revenues. So in order to assess the value of Instacart, I need to approach this in 4 steps. Now, first, I need to understand the grocery business. I know Instacart is not a grocery company, but it is tied, whether you like it or not, to the success of the grocery business. How quickly is it growing? How profitable is the business? Because it's going to give you a sense of how much buffer there is in the business for Instacart to make money as an intermediary. So I'm going to start with that. Second, I'm going to look at the evolution of online grocery shopping, a relatively recent phenomenon, because unlike other aspects of brick and mortar retailing, where online retailing made inroads 20 years ago, online grocery shopping has been slower to take off. We'll talk about why that might be and why there might be a ceiling on how big this market can be. Third, I want to talk about how competition to Instacart has evolved since 2020. When COVID hit, Instacart might have been the only game in town for many consumers, but that is no longer the case. We'll talk about who the competitors to Instacart and why it's going to be difficult to claw market share back from them. And in the final segment, I want to talk about the cost structure of being an online grocery delivery company like Instacart. What are the costs you face, and what are the dynamics of that cost structure that can allow you to become more profitable over time? Let's start with the grocery business. Now, when people ask me to give them a company that will be easy to value, where you don't have to have much of an imagination, you can just take past data and just extrapolate, I suggest that they value a grocery company. And there's a reason for that. The grocery business, at least in the US, is a slow growth business. It's a mature business. In this graph, I look at revenues collectively at grocery stores, starting in 1992, going all the way through 2022. So if you look at the compounded revenue growth, for much of this period, the revenue growth has been about 2 to 3%. That's at inflation or below. It's true between 2013 and 2022, that growth rate was slightly higher, but much of that came from jumps you saw in 2020, which was the COVID year, and 2022 because of inflation. So it's almost like outliers that are going to disappear. This is a slow growth business. I don't think that's debatable. It's also a low margin business. Grocery stores don't have 20 or 30% margins. If you look at operating margins, their margins are around 5%. Slightly higher now than they used to be, perhaps because of a shift towards packaged and processed foods. But even with that shift, it's a 5% operating margin. Why is the operating margin so low? Because you start with a gross margin. It's the margin you have after just covering your cost of goods sold of less than 25%. Just to give you a contrast, a software company can have a gross margin of 80 or 90% and an operating margin of 45%. Grocery stores are going to struggle to get to single-digit margins, and they have. So it's a low growth, low margin business, and that's going to play a role in how the story plays out. Finally, the grocery business is heavily concentrated. It used to be concentrated among traditional grocers, but the game has changed over the last 20 years. The biggest grocer in the US in terms of grocery revenues is actually Walmart. Walmart gets about almost 55 to 60% of its total revenues in the US from groceries. 26% of the overall grocery market is Walmart. It's followed by Kroger, the largest single standalone grocer at 18%. And Kroger and Albertsons actually are grocery companies that have been created by consolidating smaller grocery companies. Interspersed between Kroger and Albertsons is Costco. And that's another trend. In addition to Walmart and Target, traditional retailers entering this business, you're seeing big box stores, Costco, Sam's, BJ's entering the game and essentially taking a larger share of the market. In effect, this is a consolidated market with traditional grocers, retailers, and big box stores competing for big chunks of the market share, which also means that if you're an intermediary negotiating with grocery stores, you're negotiating with giant companies with tremendous bargaining power. Now, within that market, let's talk about why online grocery shopping has been slow to take off. Now, if you think about online grocery shopping, and I might be generalizing here, so forgive me if your experience is different, most of us tend to shop at a specific grocery store, a grocery store that we're familiar with. Why? Because if you ever walked into a US grocery store, it's like walking into a foreign country. Finding the item you want can be a nightmare if you're not familiar with the store. You stick with the store you're familiar with, and it tends to be a store close to you. Why? Because you don't want to drive your groceries 25 miles home, because God only knows what will happen to your frozen food by the time you get home. So most of us shop at a specific grocery store with an add-on of 2 or other stores for specific items you might not be able to get at the grocery store. And most of us preferred to shop, at least until recently, prefer to shop physically at grocery stores. Because unlike a brick and mortar retail store where you can look at a picture of an item and order it, especially if you're buying produce or meat or fish, you might need to look at what you're buying, perhaps even touch it. I think some stores allow you to do that before you buy it. So over time, historically, people have preferred to physically shop in grocery stores, and I don't think that's going to change, COVID or no COVID. The bulk of the shopping in grocery stores will remain physical shopping. Now, COVID did have an effect. If you look at the years leading into 2020 and you look at the percentage of people who were willing to shop at grocery stores or expected to, the percentage was fairly low. This isn't even the percent of people who shop at grocery stores, it's just online. It's a percentage of people who are willing to shop online. So prior to COVID, that number was less than 40%. COVID, of course, made a difference. You saw a huge jump in the percentage of people willing to shop online for groceries and who expected to shop online. The game seemed to have changed, and that is what Instacart took advantage of. But if you follow through and look at what's happened since 2020 and expectations for the future, it's clear that the spurt in growth you saw in 2020 has leveled off. You're not seeing huge percentage of people shift away from shopping in grocery stores to online grocery shopping. In fact, the expectations are that while online grocery shopping as a percentage of overall grocery shopping will continue to climb, it's going to be capped around 20%. Even optimists don't see more than 20 or 25% of grocery shopping coming from online shopping. So it's about a 10 to 12% growth that's expected in online grocery shopping for the next 5 years, and perhaps lower than that beyond. Now, if you look at who dominates online grocery shopping, it used to be Instacart in the middle of 2020, but that's no longer true. The largest online grocer in the US in 2023 is Walmart. Why? Because most grocery stores have discovered that having an online option for people to shop at their store is a winner, usually for pickup. So you see Kroger, you see Walmart, Amazon, of course, through both its Whole Foods and Amazon Fresh. Instacart has a significant market share, 21%. But if you think about increasing market share in this market, you're going up against players who have an advantage over you. Kroger and Walmart will always have an advantage over Instacart on people who shop at those stores because they effectively have no cost. They can have employees who shop for the shoppers and save themselves the cost that Instacart has to pay its shoppers. Incidentally, the people who shop for you when you have an Instacart order are called Instacart shoppers. Many of them also drive those groceries home if you order delivery. That's a big cost, and we'll come back and talk about that cost for Instacart. Now, in terms of operating economics, those shoppers are the biggest cost the company faces. They're the cost of goods sold. And like the ride-sharing companies, there is a question that hangs over Instacart. Up till now, Instacart has been able to categorize these workers as independent contractors. What does that allow them to do? It doesn't have to, it means that when it comes to things like healthcare, they don't have to provide insurance to their workers. They can keep the hours at below 30 in the states that have a 30-hour requirement. It in general keeps costs low. That is going to change over time, and we'll talk about how that change is evolving. But even within that system, there is a question of how Instacart pays those shoppers. Instacart's traditional model is it pays its shoppers based on the batches of work they do. It makes it a variable cost. The more orders they fill, the more money they make. The advantage of making it a variable cost is less risk to the company, because if you have no orders, you don't have any costs. But it does mean that any economies of scale from making the company larger are also going to be lower because your costs are variable. And as I said, the independent contractor versus employee debate is going to play out. And it's going to play out in legal settings. In fact, in California, Instacart recently had to pay $46.5 million to settle a lawsuit that its employees should be treated as employees rather than as independent contractors. Now, in terms of as a company built around a platform, a technology platform, there are going to be costs in R&D and acquisitions of other companies to add to that platform, as well as customer support services. We'll come back and look at how those costs have evolved at Instacart, but that should give you a framework on the business that Instacart is entering. So let's take a look at the Instacart IPO. I started by looking at the prospectus, and forgive me for this, but that prospectus, gave rise to a lot of pet peeves I have about how prospectuses in general have evolved over time. A couple of years ago, I wrote a piece on exactly this point, and I called it disclosure diarrhea, where disclosures are getting larger and larger, more and more bulky, but less informative over time. Just to give you a sense of how much prospectus have shifted over time, Microsoft and Apple, when they went public in the 1980s, had prospectuses of 46 pages and 60 pages, respectively. That is well in the past. If you look at prospectuses in recent years, they've become 200, 300, 350 pages, and Instacart's prospectus weighs in at 416 pages. It's a lot of bulk. And a lot of it is wasted. Now, the second pet peeve I have is how every company in the last decade has decided to call itself a technology company. Now, we can debate that with Instacart, but it is a grocery delivery company which happens to use an app. If that makes it a technology company, fine. But I think companies like that word technology because they think it gives them a premium. The other big buzzword at the moment, of course, is AI. And I did a search through the prospectus and there were 32 mentions of AI. Forgive me for being cynical, but I don't think AI is going to revolutionize the way I shop or going to revolutionize cost structures at an online grocer. But you can see why Instacart felt the urge to include the word. Maybe it'll give them a premium. The third peeve I have, and this is not just with Instacart, but with not just with companies, but with the analysts who track them, is this idea of adding back stock-based compensation on this misplaced view that stock-based compensation is non-cash and therefore can be added back. That is nonsense. Stock-based compensation is in-kind compensation. You're giving away pieces of equity. It costs you. And adding it back is absurd. So this notion of an adjusted EBITDA makes no sense. But you know what? Instacart follows the script and adds back, stock-based compensation. Now, and I think it's silly because Instacart is actually making money without any of those adjustments, and making these adjustments actually gets in the way of that story. And finally, share count at companies going public has become really messy. You have the shares outstanding, but then you have restricted stock and options. And if you look at the Instacart IPO, they give a share count and then they list out tens of millions of shares that they've excluded from that share count for lots of different reasons, most of which have no basis. There are in fact 43.62 million shares that they've excluded, many restricted shares that I add back to the total share count to come up with a total share count of 323 million rather than the stated number of 279 million. So it might be unfair to pick on Instacart because every company that's gone public in the last decade has played this game. But I wanted to start with those pet peeves. Let's take a look at Instacart's financial history. If you look at the shifts over time, 2019 through 2020 was a game changer. Why? COVID hit. The number of orders, the gross transaction value that happens on the platform, the revenues that Instacart collects pretty much all soared in those years. And the good news is that growth has continued, but at a much lower rate. So the growth has continued. So you've not lost the people who've joined you during COVID, but the growth has leveled off. It's good, but it's not astronomical. But even better news, it looks like the company is turning the corner in terms of profitability. Remember, this is not adjusted EBITDA. This is actual operating profit. In the last 12 months, they reported an operating profit that was positive. That's unusual for an IPO. It reflects the changing of the game between 2021 and 2023. Now, I have to caution you, since these are last 12-month data and the people who've run the company have known that they're going to go public, there is a bit of window dressing involved. So I would take that with a grain of salt. But I do believe that the company is getting more profitable over time. So let's break down the drivers of Instacart's profit model. The first is, remember, when you place an order on the Instacart platform, Instacart's revenues represent the percentage of the order that they get to keep, the fees, the delivery fees, the transaction fees, the service fees as a percent. That's called the take rate. In this graph, I've looked at the take rate for Instacart over time. And there's some good news here. The take rate, which was 2.86% in 2019, doubled in 2020. There are economies of scale kicking in. And even better news, that those economies of scale are continuing. You're seeing the take rate. And to get the take rate, I'm looking at the transaction revenues. Remember that Instacart makes revenues from both transactions and advertising. This is just the transaction revenue. The transaction revenue, the take rate has gone from 5.7% in 2020 to 7.5% in the last 12 months. Much of that improvement, again, happened in the last 12 months. Grain of salt, but still worth taking into account. The take rate has improved. It's still low, much lower than DoorDash, which has 11.5%, or Airbnb, which is 15%. If you're wondering why, remember the margins that I showed you for the grocery business, 5% margins? When you're an intermediary in a low margin business, your take rate, almost by definition, is going to be much lower. There is not much fat to burn. DoorDash deals with the restaurant business, much higher margins, 15%, 16%. I think the average margin for restaurant businesses in 2022 is 16%. When you have 16% margins, you can afford to have a much higher take rate. Bottom line, I expect economies of scale to continue, but I don't expect the take rate to continue to go up because this business comes with a ceiling on that take rate. Let's take a look at operating expenses. If you look at the income statement for Instacart, it reflects three big operating expenses. The cost of goods sold, it's the cost of those Instacart shoppers and everything involved in actually delivering on the orders. You also have operating support. This is the support that Instacart offers to the people who use the platform and have trouble with their orders. And finally, you've got G&A, which is the other cost of actually running a company. What I've done in this graph is looked at those costs over time, and obviously those costs are changing. And also it's a percentage of sales. You're saying, what does that tell us? It tells us something about the economies of scale in this business. The good news is there are economies of scale, and I mentioned that earlier. These expenses as a percentage of revenues have all decreased over time. So that's the good news, is the company is, as it's scaling up, becoming more profitable. I do think, as I said, there will be a cap on this profit, but it has turned the corner because it's scaled up. Now, if you look at the big capital expenditures for this company, the reinvestment it puts into growth, there are two big items. One is the cost that Instacart spends acquiring new customers, and the other is the cost of R&D. Unfortunately, accountants screw up the way they account for these items, treating them as operating expenses. What I've done is split them out of operating expenses. And I've taken the customer acquisition cost and broken it up into marketing and promotion and incentive costs separately, and the R&D cost on top. Here, the news is less positive. Clearly, in 2020, these expenses dropped as a percentage of revenues. So 2020 was a good year in terms of lower customer acquisition costs, lower R&D. Since 2020, though, those numbers have started to go up again as a percent of revenues. I don't want to read too much into it, but if I look at these numbers, it suggests to me that Instacart is working harder to deliver growth post-2020 than it did in 2020. And why? You remember that breakdown of competition. Their competition has become more intense in this space, and it's showing up in these costs. Finally, when you have a transaction-based company like Instacart, it's worth looking at what's called unit economics. What do they make on the next order that comes on the platform? So let's lay the basis for that. If you look at the average order going through on the Instacart platform, it's remained remarkably stable since the start of the game for Instacart. It's, here I've looked at just 2019 through 2023. It's been about $100 per order. There was a jump in the second quarter of 2020 at the peak of the shutdown. But the order size has remained remarkably stable. Is that good news? Is that bad news? I don't think it's particularly surprising. You don't order 3 times as much groceries one year as you did the previous year. So the order size by itself is neither good news nor bad news, or it is a little surprising that as inflation went up in 2022, you didn't see the order size go up. On an inflation adjusted basis, the orders are getting smaller. It's okay if people are ordering more frequently, right? So to answer that question, I looked at what's called a cohort table. This is actually a very useful table when you have people on a platform and you're trying to track how they behave the longer they stay on your platform. So the way to read this table is if you look at the 2017 line item, these are the people who signed on to the Instacart platform in 2017. The year one revenues represent their starting year. In year two, they ordered 173% of what they ordered in year one. So you can see over time that the people who joined in 2017 are ordering more and more on Instacart as you go through time. In fact, by the time you get to 2023, they're ordering 3.5 times more than they ordered in 2017. Same thing is true for 2018, 2019, 2021. By 2020, you see that the opposite happens. And unfortunately for Instacart, the biggest chunk of the users joined in 2020. And what you're getting here is a leakage that's happening of people who joined in 2020 who are less and less inclined to use the model. Again, not surprising, but something that might explain why growth is getting more difficult to deliver. So I'm ready to tell my Instacart story. You're welcome to disagree with me. And as I said, I'll give you a spreadsheet where you can go in and change. So rather than bitch and moan about how much you dislike my story, make it your own. I'm going to assume that online grocery retailing will continue to grow, but at a much lower rate than it did in 2020. In fact, reflecting what I think are consensus expectations now, I think the growth rate is going to be about 12%. Its share of the grocery market is going to go from about 14 to 20%, but that's pretty much the cap. So I would expect a compounded annual growth of about 12% in gross transaction value on the platform. I will assume that Instacart will be able to maintain its market share in the face of competition from Walmart and Amazon and any new players in the game. And remember, DoorDash and Uber Eats are also trying to edge their way into the game. But the only way it's going to be able to maintain its market share is by cutting its fees, its service fees, which will bring the take rate down from 7.5% to 6%. This is not an upbeat, huge story. This is a pretty conservative story, but I think it fits a company. So gross transaction value grows at 12%, the take rate comes down. I will assume that advertising revenues, because they're tied to people just getting on the platform, will keep track with the gross transactions on the platform and grow at 12% as well. In terms of profitability, I do believe that the economies of scale you saw in 2021 and 2022 will continue, and you're going to see operating margins improve over time, but they'll be capped around 25%. Why? Because when you look at the more mature companies that have the same model, the ride-sharing companies, Airbnb, the restaurant delivery companies, you're starting to see the tensions between the company and what makes it run, which are the people, the shoppers in this case. Those tensions are going to play out as higher costs over time. Then we're going to put a cap on further improvement. 25% is a pretty solid margin for a company, so I'm going to cap it at 25%. As for reinvestment, I do think that the company will return to its capital light roots once the big growth ambitions have scaled down. It looks like they have. So I'm going to assume that the company will deliver about $3.13 in revenue for every dollar of capital invested. Those are the big drivers. And in terms of risk, I do think that this company will be riskier than the typical company in the market. I gave it a cost of capital at about the 75th percentile of all US companies, about 11%. And I do assume that over time, that'll move down towards a median cost of capital for a US company, 9%. The numbers play out. You get 12% growth in gross transaction value. That's the column. The take rate decreases over time from 7.5% to 6%, giving me transaction revenues. You add the ad revenues that grow at the 12% that gross transaction values grow at. You get total revenues. The operating margin improves over time from about 15% to 25%. And you can see that the reinvestment is a relatively small number because it's a capital light model. Taking the present value of those cash flows, and allowing for the fact that there's still a chance of failure. This is still a young company. A big lawsuit could potentially put it under regulatory risk. I'm going to give it a 5% chance of failure because it does make some money. It's not at as much risk as a money-losing company. I get a value for the equity of about 10.14 billion. I value the options as options, right? Basically, it's allowing for the fact that they have time value attached to them. Subtract that value out, 652 million. I get a value for the equity of about 9.5 billion. And you divide by the updated share count that I have, I get a value of about $29.37. Forget the last two decimals. That's hubris. About $29. That's very close to the $28 that you saw as the original, the bottom end of the offer price, and even the $30 that the offer price was raised to after the ARM offering last week. The company looks like it's close to fairly valued. Now, that wasn't what I was finding in 2019 and 2020 when I was valuing IPOs. Clearly, this company is being valued to reflect the market we're in. Now, of course, you could disagree with my big assumptions, and my big assumptions are about the growth and gross transaction values. Maybe I'm being too optimistic with 12%, or too pessimistic. Actually, those numbers are wrong. The gross transaction value growth is around 12%, so I'll have to fix that. The take rate of 6% could be higher or lower. The operating margin could vary over time, and so will the cost of capital. But allowing for variation in those inputs and running a simulation, allowing for those changes, the value per share that I get for the company, is centered around 29. And you can see the range is surprisingly tight for a young company. It's about $24 to $36, 10th percentile to 90th percentile. The reason I emphasize that usually with young companies, you get a much bigger range and you usually get a bigger tail. In other words, if things go really well, you get a much higher value in the upside. This, Instacart looks remarkably like a more mature company in terms of the distribution of value. And that's going to play a role in the buy or sell decision I will make on the company. So let's talk about the offering. I've long mentioned that IPOs are a pricing game. They're not a value game. That the way bankers put a number on a company is a pricing. The way investors or traders decide whether to buy or sell is based on a pricing. And you say, what's the difference? In valuation, you have to try to grapple with the business model and how it plays out in the numbers, as you saw me try to do in the intrinsic valuation. In a pricing, you know how you attach a number to a company? You look at what other companies that you think investors are comparing this company to and what people are paying for those companies. In this case, I've actually compared Instacart to DoorDash, which I think is the company closest to it in terms of business platform, and Airbnb, a very different business that they're going after, but similarly an intermediary platform. I've looked at the market cap and enterprise value of Airbnb and DoorDash because they're publicly traded. I've got Instacart's pricing at the original $28 pricing and enterprise value. And I also have the fundamentals that I think should drive the pricing: gross transaction value, revenues, EBIT. And I've computed three multiples. The multiple of gross transaction value. And in that dimension, you can see Instacart looks incredibly cheap relative to DoorDash and Airbnb. But before you get too excited, remember Instacart has a much lower take rate than Airbnb and DoorDash, which explains the lower pricing. A much lower multiple of revenues, which suggests that investors are pricing in an expectation of lower growth and lower margins in Instacart, and a much lower multiple of EBIT. So on a pricing basis, Instacart might look cheap, but before you jump in, remember that there are fundamental differences between Instacart and these peer group companies. As a preview, now it should be mentioned that when I looked at the Instacart offering details, it's clear that the people who are preparing this company to go public are very realistic that this is not the 2021 market. I've never seen an IPO so swaddled in safety blankets. In what way? First, the offering price was set pretty close to a conservative value for the company. Instacart also lined up what are called cornerstone investors who agreed to buy up 60% of the offering. In this case, many of them are already investors in Instacart, but they provide a floor on the price. So it's a pretty risk-averse offering. And as with any offering, it's going to be driven by mood and momentum. And in this case, because there have been so few IPOs in the last year and a half, people have very little to go on. That's why the ARM IPO was so widely watched. For those of you who tracked that IPO, it was offered at 51, jumped to 56, ended the day at 64, climbed as high as 66. That's a pretty good news for the IPOs lined up. And one reason why you saw the IPO offering price for Instacart jump or increase to 30, the upper end of the range, was because how the ARM IPO was priced. It's entirely possible that that mood, the good mood from the ARM offering, will spill over into the Instacart offering, and you will see its stock price jump from the offering price. But this is a moody market. I've seen mood shift dramatically. Even on the ARM IPO, the price jumped to 65. It's now back to 55. Who knows what it'll be a day from today? It's entirely possible that Instacart will get a chilly reception because either the mood has shifted or it doesn't have that magic AI component that ARM does. We'll just have to wait and see. Now, as an investor, of course, I'm just a spectator for the moment. If it opens at 30 and goes up to 38, I'm not selling short. I'm just watching. It'll be fun to watch. If it has a bad reception and drops to 22 or 23, I'll be willing to jump in. I think that, no, but I will do it with open eyes. I will buy it as a moderate growth company, which is going to have pressure on its margins and its take rate over time, which is how I value the company. Now, there is, of course, the question of what VCs will get out of this process. I know over the last few decades, especially the last decade, when VCs were viewed as superstar investors. Why? Because we saw stories of incredible success of companies, and there's a selection bias in what we read. And also some VCs are relentless self-promoters. They try to promote themselves as people who can judge businesses, amazing gaugers of whether a business will pay off. I've never believed that about VCs. I think many successful VCs share more with successful traders than they would successful investors. They play the pricing game. Now, what does that mean? They get judged on timing, when they enter and when they exit, gauges of mood and momentum. So to get a sense of how VCs in Instacart have done over, I went back and looked at every VC round, starting with the seed round in 2012, and looked at the returns you'd have made as a VC if you'd been in that round. So let's start with the clear winners. Series 12, the 2012 and 2013 investors clearly delivered. If you look at the compounded annual return from the price they entered in at and the 9.3, 9.5 or even $10 billion pricing on the IPO, they're going to make 55-60% a year, well ahead of the S&P 500 compared to what you'd have made if you'd put your money in an index fund. In fact, perhaps you can compare to the NASDAQ, which is even higher than the S&P 500. By the time you get to Series B, you're starting to see more moderate returns. So in 2014, when Andreessen Horowitz invested in the company, their pricing would have given the 29% return. Every investment since 2015 by VCs, the return you'd have made on the investment is less than what you'd have made on an S&P 500 index fund, and worse if you compare to the NASDAQ over the period. Every VC investor since 2015 has had negative returns. And of course, the worst returns have been reserved for those people who jumped on in 2020 and 2021. 2021, the company was priced at $39 billion briefly. Fidelity, T. Rowe Price, and Sequoia were the people who supplied capital to the company. For Fidelity and T. Rowe Price, there's no redeeming feature. This was a loser in every sense of the word. And I think it reinforces a point I've always made about Fidelity and T. Rowe Price. These are public market investors. I don't think they have any business in the private company space. Sequoia is more of a mixed blessing. Because note that Sequoia was also the investor in the Series A investment, where their $75 million got them a large chunk of the company. They are the largest owner, so the Series I was a loser, and they're going to write off a big chunk of the $300 million invested in the Series I. But if you look at their collective investment, they're going to still come out as winners. So I'm not going to use this table to argue that VCs are bad investors. I think VCs are like everybody else. They got caught up in mood and momentum. They're on at least in the aggregate, average investors, they make the same mistakes that everybody else does. They just they're just traders on steroids because they have a lot more capital to make big mistakes or have big winnings on. So as you look at at VC performance on Instacart, I want to reinforce a point I've made earlier about smart money. There is this widely held notion that there is smart money, that there are investors who are wiser than the rest of us, more informed, less likely to act on emotion, that somehow win while we're losing. I've never believed that. I've looked for smart money for 40 years. I've never found it. It's a mirage, and every group that's labeled as smart money sooner or later meets its maker, comes apart. Mutual funds were viewed as smart money in the 1960s and 70s. So people who lifted the lid and said, not really. The average mutual fund underperforms the index by 1.5%. 20 years ago, it was hedge funds, amazing investors, smart people. Look at the brilliant people it draws in. Early on, hedge funds beat the market. Hedge funds in the last 4, 5, 6 years have become very average investors in the aggregate. Doesn't mean that there aren't big winner hedge funds, but hedge funds have met their maker. Venture capital, I think investments like Instacart should make it clear that venture capitalists are like any other group of investors. They have a few brilliant investors who make a lot of money. And perhaps one thing that's different about venture capital is the winners have a greater chance of staying winners because of the way the process is structured. Why? Because if you're a winning venture capitalist and I'm a founder with a startup, I'm more likely to give you better terms because I want you on my list of venture capitalists because you can draw on other venture capitalists. But overall, I think this search for smart money leads us to bad places. The notion that venture capital is no more, I think we need to dispense with that because they make the same mistakes that the rest of us do. I hope you found the session useful, and thank you very much for listening.